If you're looking to get started in investing, saving, and building wealth for the future, congratulations, you are going to be hit with a torrent, an absolute avalanche, a waterfall of information and choices about how to invest and what to invest in. I subscribe to the keep it simple, stupid method, right? And I've made a lot of mistakes over the years. I've read a lot. And I've got a couple of very basic philosophies, and I'm going to share those with you today, and I'm going to tell you exactly what I invest in almost any platform I'm using. So stay tuned. All right, welcome back, y'all. Appreciate you being here. If this is your first time to the channel, please hit the subscribe button. Please give me a like. It really helps me with that YouTube algorithm. But like I said, if you are getting started in investing, then you have got to prepare yourself for a torrent, an avalanche, an absolute waterfall of information coming your way from every source imaginable. They're going to tell you how to invest and where to invest in all these different philosophies, and it's going to be overwhelming, and we don't want you to not get started. And so what I'm going to do is I'm going to actually share with you exactly what I invest in and what I have, whether it's a retirement plan or an individual plan that I'm doing, right? Not retirement. I'm going to share with you exactly what I do and where I came up with this from. I've got a couple of basic philosophies I'm going to share with you here as well, but I need to say up front, I am not a financial planner. I am an engineer. I am a realtor now, and this is a little bit of hard knocks. This is a lot of reading, a lifetime of being interested in the stock market and exactly how investments work. So I want to impart on you some information, but the most important thing is to get started. You, especially if you're younger, you have decades of savings and investings ahead of you, and the power of time. I'm going to do a whole video on it. It's unbelievable what you can do with time on your side. But getting started is probably the hardest thing, because once you make that decision, there's a ton of options out there. In addition to platforms like Acorn that'll round up your transactions and then deposit those pennies over here into an investment, Webull that allows you to buy stocks, you've got Vanguard, you've got TD Ameritrade, the websites out there. You've also got all of the choices about whether it's a retirement plan, whether it's a mutual fund, an exchange traded fund, bonds, the international market, should you hold gold? I mean, there's all kinds of options out there. And sure, as you get more assets and maybe partner with a financial advisor, you might start spreading things around a little bit. But the most important thing you can do is, if your employer offers a retirement plan, invest the maximum you can where they're matching. So if you can put 4% of your salary in and they're going to match 4%, absolutely do it. That 4% is free money for you for the future. But outside of your retirement plan, you can actually have your own self-directed IRA as well as investments. And that's what you need to be doing. But the question still remains, where the heck do you direct these things to? What do you actually invest in? You don't just pick a 401k and it magically happens. They're going to immediately ask you, now what are you going to invest in? Here are your options. The first premise I'm going to start with is I do not believe that individual investors should be buying individual stocks, okay? It's sexy, I admit, and if you want to go on Wall Street bets and you want to get involved in the next shorting of GameStop, hey, knock yourself out. It's your money. But recognize what you're doing is nothing more than gambling. It might be educated gambling, but it's nothing more than gambling. I have invested in individual stocks, and most of the time it hasn't gone very well for me. No matter how much I know about the industry, no matter how much I know about the individual companies, you cannot predict the future. And there is several different ways you can look at it. There are people who look at it from a technical side of actually reading the stock price and looking for hooks and things like that. There is value investing, looking for stocks where the stock is undervalued for the sales and the projected sales of those companies, believing in the leadership team. But here's the deal. There are people who work for these big firms. This is what they're trained in at college. They're trained at their company. They spend all day long looking at this kind of information. And the fact of the matter is about half the time, they can't even beat the market. So why do you think with a full-time job that you can. You know, you do hear stories about people who get really good at it and they manage to hit it big, but what's buried is the millions of people who lose little bits all along the way. So the best answer is that instead of trying to beat the market is to invest in the market and to follow it. So let's roll back to when I was in my 20s and I was reading about investing a lot, and I got a book, and as I recall, it's this one right here, the first Motley Fool book. And unfortunately, I don't have it anymore. It got lost during some move at some point, but I've never forgotten. And the foundation of my investments, whether it is a 401k, whether it's a independent IRA I've got, whether it's just my non-retirement investments, I basically follow the same investment strategy. It's a little bit modified now because I do have a financial advisor, and I will say up front, I do not have a lifetime growth that I can show you because as I've changed jobs, I've rolled 401ks into different places and tried to consolidate things, and we just relatively recently moved to this one location. I don't want to try to piece all that together, and we have kids. I don't want to try to tell you how much I have right now because I really don't want my kids coming back to me and be like, Dad, buy me a car. So what does that mean? Well, the basis of it is the S&P 500. Now, the S&P actually started originally 1926, I think, and I think it had 50 stocks in it, something like that. In that time, it has averaged somewhere around 10%. Now, they got up to 500 stocks in the S&P, and since that time, they've been averaging somewhere around 8%, as I recall. An S&P 500 index fund looks at the S&P and then buys all of those stocks, and so you're tracking the overall market of the largest companies. Easy way, and you're going to have, over time, history tells us, good returns from it. Now, what I do is add two other index funds to it. One would be a small cap fund. So you think about the scrappy little companies that are up and coming. Hopefully they've got a revolutionary idea, but they're not big enough to get up into the S&P 500, of course. Those guys can have massive returns while also having big failures. So it's a little more volatile, but I'll put 1/3 of my money into a small cap fund. And then you also have to recognize in a global economy, this has become even more important as years and decades have gone on, that different areas of the world will do well at different times. Certainly you've got America doing strong while other parts, say Japan in the 90s and 2000s was really struggling, whereas right now China is ascendant, America's doing well, but maybe Europe's not doing so well. Also invest into an international fund, so that way you're capturing strengths of the market through each one. So I know this was a long prelude to what amounts to a really simple investment strategy. An S&P 500, a small cap fund, and an international fund. Broadly, I try to keep those balanced about 1/3 into each one. But no matter what I do, I can still, what platform I'm doing, whether it's a 401k or just I'm investing in, I can go in at each one of those. Now, it's rather aggressive. My wife actually chooses less aggressive, and she's had very, very good returns, certainly as the stock market's performed well the past few years. But this is a really simple way to capture a lot of the market and stay invested in stocks without getting into bonds and gold and everything else. So I hope this helps. It's performed very well for me. I'm always excited to go look and see how things are going. But as with any stock, you've got to have that long-term view, because when the downturn comes, and there will be one, you will see your stock values decrease. That's where we talk about dollar cost averaging in another video. You've got to ride it out. You don't lose until you sell. So there's a simple strategy. I'd love to hear your thoughts on it. It can get a lot more complex, but I want to keep it simple and give you an idea to get started with, to cut through all that mental clutter that you're going to be hit with when you start investing. So let me know your thoughts below. Thanks.